Warren Buffett. You hear the name, you instantly think, wow, incredible wealth, right?
Absolutely third richest person on the planet. It's almost mythical.
People call him a wizard, an oracle, a sage. Like, his success is some kind of magic.
Yeah, but the really fascinating story, maybe the more useful one for most people, is about young Warren Buffett.
Exactly. How he built that initial fortune using strategies that, honestly, most people don't talk about much today.
Strategies that are, well, quite different from how he invests now.
And that's really our mission for this deep dive, isn't it? To unpack those early principles.
Yeah, figure out what lessons you can actually use.
Because there's just so much out there about Buffett now. You know, our sources mention over 47 books on his current methods.
It's overwhelming. So we're taking a different angle, looking at him starting out with just $9,800.
Taking that train trip to learn from Benjamin Graham, it's a great image.
It really is. And it highlights a key point. Trying to copy Buffett today.
Forget it. The source nails it. Like trying to stop a freight train by standing in front of it.
You just can't match the scale, the capital he's working with.
And the source reassures you, you are not Superman. And that's a good thing.
Right. Because that limitation is actually your advantage. It opens up different plays.
Even Buffett himself has hinted at this, hasn't he? In those Berkshire shareholder letters.
He has indeed. Which kind of leads us into one of those early defining moments, the Berkshire Hathaway textile mill story.
Ah, yes. So he first bought shares back in December 62. $7.50 a share.
And the key thing there, the thing that caught his eye, was the massive discount.
Right. Per share working capital was what, $10.25?
And book value even higher, $20.20. So you're buying for $7.50 something with $10.25 in easily accessible assets.
That tells you a lot about his thinking then, doesn't it? Pure asset value.
Definitely. It's all about tangible, measurable worth. Which brings us to that famous analogy.
The cigar butt. Love this one.
Me too. He said buying Berkshire at that price was like picking up a discarded cigar butt that had one puff remaining in it.
Though the stub might be ugly and soggy, the puff would be free. Just grab that last bit of value.
But here's where it gets complicated. And maybe where there's a lesson for us.
Go on.
He didn't just take that one puff and, toss the butt aside.
No, he stuck with it. Poured more money in, over 25% of his partnership's capital, into this, frankly, failing textile business.
A business he admitted he didn't really understand.
Yeah.
He said he became the dog who caught the car.
Yeah, what do you do now? So why did he stick with it? What can we learn from that?
Well, maybe it's about getting emotionally invested, or maybe just underestimating how bad the core business was.
Could be. The numbers show it was rough. Berkshire's net worth dropped dramatically.
Yeah, from $55 million down to $22 million by late 64, losses, share buybacks. It was bleeding value.
And he wrestled with that textile business for, 18 years? Finally closed it in 85?
18 years. The source jokes he should have just bought an online membership business. A bit of modern perspective there.
It really highlights that even legends make mistakes, especially early on. And his initial approach wasn't always buy and hold forever.
Not at all.
Yeah.
That cigar butt strategy, while great for finding cheap assets, wasn't the whole story, and it had its pitfalls.
Which leads us to that big shift in his thinking, right?
Right.
Moving away from just fair businesses at wonderful prices.
Exactly. He realized that approach, the cigar butt hunting, just wasn't scalable. You can't deploy billions doing that effectively.
Enter Charlie Munger.
Right. Munger's influence was huge. He basically said, forget that. Buy wonderful businesses at fair prices.
A total flip. Focus on quality first, price second, within reason.
And that became the bedrock of the modern Berkshire Hathaway philosophy. Intrinsic value, long-term holdings, quality companies.
Okay, but here's the kicker for you, the listener. While that works for Buffett's scale,
the source argues pretty strongly that for sheer returns, especially with smaller capital,
those net stocks, the cigar butts, are actually better.
Yeah, the idea is you find them, get that quick free puff of value realization, sell, then find the next one. Rinse and repeat.
Buffett himself said about the 1950s, using that strategy, "The many dozens of free puffs I obtained made that decade by far the best of my life for both relative and absolute investment performance."
He wasn't shy about it. It was about frequency and finding lots of these opportunities.
And the numbers from back then, they're just wild.
Unbelievable, really. From 1957 to 1969, his average annual return was 29.5%.
Compounded, giving a cumulative return of nearly 2,800%. Just think about that.
Now, compare that to the Dow over the same period.
Okay.
The Dow averaged 7.4% a year, cumulatively about 150%.
And the Dow had down years and
5 down years, I think. Whereas Buffett,
positive returns every single year, including a massive 58.8% in 1968. That's beating the Dow by over 50 points in 1 year.
wow. So what does that huge difference tell you?
It really screams that those early strategies, rooted in Benjamin Graham's principles, were incredibly effective for generating high percentage returns, especially focusing on those net stocks companies trading below their net current asset value, and holding concentrated bets sometimes, like with Western Insurance.
Definitely. Now, finding those back then, that was hard work.
Yeah, the source mentions relentless man-hours, digging through Moody's manuals by hand.
Imagine that. But things are different today, aren't they?
Well, the source points out that finding these internationally, using modern tools, it's much more accessible. It mentions net hunter specifically.
So the information barrier is lower. You don't need to spend weeks in a library, perhaps.
Which makes you wonder, why aren't more people doing it? Especially when you look at Buffett's later returns. Still great, obviously.
Undeniably great. But that 19.4% compounded annual return for Berkshire from 65 to 2014.
It's over 10% less than those early years, as the source notes.
And even that 19.4% gets a big boost from the tail end of that incredible early period in the late 60s.
Plus, Berkshire had some down years later on, and years where the S&P 500 actually beat it.
Which isn't a knock on Buffett. It's just the reality of managing enormous sums.
But maybe the most powerful point comes from the man himself. That quote from a Berkshire meeting.
Oh yeah, that's a fantastic quote. He basically says,
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks.
very low PEs and maybe below working capital and all that. And crucially,
I would do far better percentage-wise if I were working with small sums. There are just way more opportunities.
he lays it out perfectly. If you're working with a small sum, you have thousands and thousands of potential opportunities. We have relatively few possibilities.
And then the punchline for the listener. So you have a huge advantage over me if you're working with very little money.
That's the core message right there. Your smaller size is an advantage in this specific arena.
Thousands of opportunities he literally cannot touch because they wouldn't move the needle for Berkshire.
Exactly. So let's unpack those classic Graham stocks a bit more. This goes back to Benjamin Graham, the father of value investing.
Buffett worked for him starting in 54, learned the ropes.
And Graham's big thing was these net stocks. It's important to know what that means specifically.
It's not just cheap, right?
No, much stricter. A net is when the company's market cap is less than its net current asset value.
Which is basically cash, receivables, inventory, the really liquid stuff, minus all liabilities.
Total liabilities, yeah. So it's a super conservative measure of liquidation value almost.
And Graham's rule was tough. Only buy if the price is 2/3 or less of that NCAV.
Right, and sell when it gets back up to full NCAV. Talk about a margin of safety.
A huge margin of safety. And the source makes a great point. You don't really have to know a thing about the industry for this.
You're just buying assets for, say, 50 cents on the dollar. It's balance sheet focused. Compare that to Buffett struggling with the business of textiles.
Totally different game. And the historical returns for Graham's method are pretty solid.
Very solid. Studies show average returns often in the 20–35% range.
The source cites one from 1970–1983 showing 29.4% average annual returns for stocks meeting the criteria.
And Buffett himself expected these to pay off relatively quickly, usually within 2 years, like 70–80% of the time.
That quick puff again. Get in, get the value, get out.
Yet, so many investors today just ignore these kinds of stocks, don't they?
Yeah, everyone wants the big names, the long-term holds, maybe because that's what Buffett does now.
But Graham and young Buffett, they were contrarians, looking at the small, ignored, maybe even ugly companies.
Finding treasure in the trash heaps, so to speak.
And while finding them was tough back then, the source suggests it's more about filtering today, using modern tools, looking internationally.
And focusing on quality within those nets. Strong balance sheets, which is pure Graham thinking safety first.
That focus on quality seems key. The source even gives a performance comparison for the last 3 years.
Right. S&P 500 at 18.7%, Berkshire at 61%.
And our community net portfolio at 240%.
Again, not saying anyone's better than Buffett overall.
Absolutely not. It's about the strategy fitting the investor. And his early strategies, the source argues, help build the foundation for that specific portfolio.
As the source puts it, want similar returns. Time to take a puff of the cigar.
So if we boil it all down, the message seems clear. Young Buffett's playbook, inspired by Graham's net approach.
Might actually be a more potent strategy for you, the individual investor with less capital, than trying to mimic billionaire Buffett today.
The big takeaway, the aha moment, is realizing your smaller size isn't a weakness here. It's a strength.
You get access to a whole playground of potential investments that are off limits to the giants.
Yeah. So maybe the final thought for you to chew on is this. How could understanding these core value principles, cigar butts, net nets, actually change your approach?
Could digging into these overlooked corners of the market be your own kind of train ticket to potentially better returns, just like it was for that young guy from Omaha all those years ago? Something to think about.